Ladies and gentlemen, we have a crisis in South Korea, apparently overnight, inducing martial law. We will discuss that and impacts on our markets in this video. Besides that, we did get some big U.S. economic data out today with JOLTS job openings, and it was actually pretty good. It's a good sign for the economy, at least, heading into our non-farm payrolls report that comes out Friday, as well as other big economic data sets like ISM services PMIs that come out here over the next couple of days. I'll give you a rundown of the economic data, when it's coming out, what to be watching out for as well here in this video. And to top it all off, we have some Fed officials, and they're giving us their thoughts on our markets, on inflation, whether or not they're looking at cutting rates December 18th, which is just about 2 weeks away. And last but not least, we have firms like JP Morgan that are calling for a very strong December, as high as the S&P to hit 6,300. This is Tom Lee's call from yesterday being reiterated around Wall Street more, and we'll talk about that as well here in this video. So let's get into it. Hit the like button and subscribe to the channel if you have not done so already, or at the very least, well, let me know what you think about this information down below in the comment section. So first and foremost to this situation going on in South Korea, martial law was declared. President Yoon Suk Yeol declared martial law, citing the need to protect the country from, quote, communist forces and to eliminate what he referred to as anti-state forces. This is the first declaration of martial law since the country's democratization in 1987. The opposition, particularly the Democratic Party, has strongly opposed this move. The National Assembly, with a majority held by the opposition, voted to lift the martial law declaration. Speaker Hu Wan-shik declared the martial law invalid, urging President Yoon to rescind it immediately. There have been protests outside the National Assembly, with demonstrators clashing with police as they tried to enter the Parliament building. Meanwhile, reports suggest that military presence was noted around the Parliament, but there were also indications of troop withdrawal following the parliamentary vote. The U.S. has expressed concern over these developments, with the Biden administration stating they are monitoring the situation closely. Other nations have issued travel advisories for their citizens in South Korea. The declaration has caused the South Korean won to plummet against the U.S. dollar, reflecting economic uncertainty due to the political situation. So as far as this martial law situation, I don't think it's really a big deal for U.S. markets, but it's uncertainty, and the markets don't like uncertainty. And South Korea is one of the, most developed countries in the world, so that's never good when you see another developed country going through these kind of issues. If more chaos brings more chaos and uncertainty, then that can weigh on our markets. It could also strengthen the dollar somewhat, because the dollar is really pegged to global currencies. So if global currencies like the won, or potentially the yen, or any other currency in that region does weaken as a result of this instability, then that could send the dollar higher, which does pressure corporate profitability on a multinational basis. So it is something to watch for, but it's not this huge black swan event for our markets. I know some people want that black swan event. Some people want markets to come down, but this is not going to be the thing that causes a market meltdown in the US. And I know some people think it could be. Perhaps it could be. But as of now, it's not that catalyst. Really, the big catalyst today for our markets was JOLTS job openings that came in stronger than expected. We were expecting 7.519 million job openings. Last month was 7.443 million job openings. So we were expecting around 500,000, around 500,000 of an increase to job openings, a little bit more than that, closer to about 600,000 job openings to open up. And we actually came in at 7.74 million job openings. So yeah, we beat estimates by quite a bit. Now, this is good news, because why? Well, if you are a company and you're looking to hire more, then your company is likely doing better. Okay, so more job openings mean companies are likely doing better. That's a good sign for the economy. That's a good sign for the jobs report that we get out on Friday. As Nick Timiraos, widely seen as the Fed's mouthpiece, kind of gives us little hints to what the Fed's going to do, likely from Jerome Powell himself. He posted this chart that says the slow to hire, slow to fire labor market continues. Private sector hiring and firing rates ticked down in October, with quits that edged up while job vacancy rates are holding steady below 5%. If we take a look at this chart, the job openings rate did come up again with the better than expected JOLTS job openings number. The hiring rate kind of plummeted though. You're back to hiring rates you've seen, during the 08, 09 recession. Not good. Job quitting rates did finally move higher, which, is interesting considering it looks like it's harder to find a job, right? Hiring rates down, job quitting rate up. That's kind of strange. The layoff rate, though, also sharply moved lower to some of the lowest levels we have seen in recent years. So overall, on net, this looks like a pretty dang good JOLTS job openings report. And this does reinforce that the U.S. economy is likely still doing just fine. And there were around 1.1 job openings in October for every person counted as unemployed. That ratio has been stable since July, according to Nick Timiraos. Ed Goolsbee said, "I am watching housing inflation most closely. This is something that I expect will come down next year." You've seen the current market rents that do not line up with the current reported inflation in shelter. This is because the CPI report is calculating owners' equivalent rents, which is really just a survey of homeowners and what they think they can rent their home for. It's not market rents. It's not actual housing inflation. It's really just a poor way of trying to calculate housing inflation. So I do expect that'll come down next year. And I think that's where one of the positive surprises could come from for markets. Fed Goolsbee also says inflation figures are a volatile series. And Fed Kugler says it is unclear if AI will net destroy or create jobs. Fed Kugler also says the U.S. may be around full employment, but need to watch how potential trade immigration changes could change that. Fed Kugler is also giving us a bit of a heads up from the jobs report coming out on Friday that could be very strong. Fed Kugler says jobs report on Friday may well bounce back given the influence of storms and strikes on the prior report. So I don't know if you guys believe in, tin from the Fed, but Fed Kugler saying that jobs report on Friday could be really strong. Now, that would be a good thing for markets. You want to see the economy doing well. You don't want to see recessionary forces that start, to come out. That creates a growth scare. That creates downward pressure on stocks. So a good jobs report is probably a good thing for markets. Yes, would that take down the odds of a cut in December? Probably. But I do think internally, like small caps, mid caps, value areas would rally on a strong jobs report. Fed Kugler says a high rate of business formation could keep boosting productivity, but need to be attentive to how other policies may change that. And there's been a lot of talk about this productivity boom that we have been seeing recently, and that's kind of what happened in the mid 1990s that caused 4-5 years of 20+% gains in the S&P, again, of course, leading into the dot-com crash. Fed Kugler says the U.S. economy is in a good position, labor market is solid, inflation appears to be on a path to 2%. Fed Kugler says October PC inflation readings consistent as of now with a return to the 2% goal, but also show job is not yet done. It says trade policy under incoming administration and Congress may affect productivity and prices. It is too soon to judge. And then even Fed Daily, which tends to be a little bit more on the hawkish side, said this, and I think this was the biggest quote of the day today: "I don't see any reason for a rate hike. The trajectory of change is down." She says the neutral rate is closer to 3% and that trade issues don't usually derail growth. The economy adjusts, and that has to do with tariffs. She's basically saying tariffs usually do not derail the economy. The economy just adjusts, which I think was pretty interesting. And Fed Daily says even if we do another rate cut, policy will remain restrictive. And she also says that a December rate cut is absolutely not off the table. And if we take a look at what markets are pricing in for the December 18th Fed meeting, there's a 75.2% chance of a cut December 18th and a 24.8% chance of a pause. So as of right now, the markets are firmly expecting a cut December 18th. Now, tomorrow morning, we have some very big data coming out. We get the ADP employment change. This is the non-government payroll report. We're expecting 150 to 180,000 jobs. It says here consensus is 150. The forecast is 180,000, so somewhere in that range. And then the ISM services PMIs. Okay, manufacturing PMIs came in good Monday morning. If services PMIs come in good as well, then that really helps to enforce that soft landing narrative. We are actually expecting the headline ISM services PMIs number to come down from 56 down to 55.5. Anything above 50 is still positive, so we are expecting this will stay in positive territory. Now, we've seen the manufacturing PMIs rebound a bit. New orders went positive. Employment was good. Prices paid came down. So that's the inflationary component of manufacturing. All of that was really good on Monday. So if things are really good with services, that's great. If services come in weak, that's not an equal trade-off, right? Because services is 80% of the economy. So even if you start to see manufacturing recover, but let's say services start to weaken, that still could induce some kind of growth scare. So you want to see services come in as strong as possible. Specifically, when you break down the certain components, you have ISM services, business activity, employment, new orders, and prices. You want to see prices come down, so less inflation in the services sector, but you want to see new orders go up, you want to see employment go up, and you want to see business activity go up. Okay, so that's what you want to be watching for coming tomorrow morning. Now, you also get a speech from Fed Jerome Powell at 1:45 p.m. tomorrow, and I have no idea what Powell's going to say. I have no idea, if he's going to speak about monetary policy or the economy or what he's going to speak about. But that could be an event tomorrow afternoon to be watching out for. And then at 2 p.m., we get the Fed Beige Book, which the Fed themselves, Fed Jerome Powell specifically, has referred to the Fed Beige Book to give the markets a better understanding of what the economy is actually doing. This Fed Beige Book is really comprised of Fed officials going out into their districts and talking with people, okay? Sometimes hundreds or thousands of business owners every month these Fed employees are doing and reporting back and creating this Fed Beige Book. So, the Fed really takes their cues from the Beige Book more than they do from other data. At least that's what Powell said a couple months ago, because the data can be pretty volatile. It doesn't give you a clear picture of what's going on, but the Beige Book more or less does. And the Beige Book, as of recent months, has been pretty negative, and that's probably why the Fed is still leaning towards this bias to cut rates, even though the economy seems to be doing just fine. Now, on Thursday, we have balance of trade, exports, and imports, as well as initial jobless claims, expecting a slight bump there week over week for initial jobless claims. But that is it for Thursday. On Friday, again, you have your non-farm payrolls and the unemployment rate. Non-farm payrolls currently are sitting at about 200,000 for your consensus estimate, and the unemployment rate is expected to rise from 4.1% to 4.4%. So that'll be big. And then Michigan consumer sentiment comes out at 10 o'clock in the morning, and expecting things are going to get a little bit better there from 71.8 last month to 73. Now here on the day today, the CNN Fear and Greed Index is moving sharply lower compared to yesterday. Yesterday you were at 66, today you are at 61. Market momentum still in extreme greed. Stock price strength is greed. Stock price breadth is neutral. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand is greed, and junk bond demand moving sharply higher, which is in fear. Percent of stocks trading above their 50-day moving average is down about 2% today to 64.87%. So 2% of all stocks are falling below their 50-day moving average today. That's not a great day, but it is helping to reset some of these super bullish expectations that some people have for markets. In just a broader look at the markets here, the Dow is negative about 0.2%, S&P barely negative, NASDAQ up 0.15% today. The Russell 2000, really the big loser, down 0.81%. Bond yields are up 1.5 basis points today, which is having some of that effect. And you can see oil is up 3% today, mainly because of some of this disruption and chaos going on over in South Korea. Gold is up 1/3% today. Silver is up 2.11%, whereas Bitcoin is down almost 1% to about 95,000 per coin. We do have some earnings today after the bell to look out for. Salesforce being the biggest company, Okta, Marvell, Pure Storage, Box, Torrid, Couchbase, Descartes, and Innovalid. Later on throughout this week, you have Chewy, Foot Locker, Dollar Tree, RBC tomorrow morning, as well as others. Wednesday, you have Centennial One, American Eagle, Five Below, Synopsys, ChargePoint, PVH. Thursday, pre-market, Dollar General, TD Bank, Build-A-Bear Workshop, Canadian Solar, and BMO. And then Thursday and after hours, you have Lululemon, UiPath, Ulta, DocuSign, GitLab, and Hewlett Packard Enterprise. Gillahern Terravis on X says liquidity continues to drive this market, and according to this chart, a Santa Claus rally is likely. Interesting how reverse repo activity approximately 25 days in advance has proven to be a good leading indicator for equities over the past couple of months. December has never been lower in an election year when the S&P 500 was up 10% or more at that midpoint. Heard Fundstrat point this out this morning on Squawk CNBC, and I had to dig in. He says, good stuff, Tom. And as I've talked about here on this channel extensively, the AI investor sentiment survey for the first time in a while has more bears than bulls, and this is the first time since April. All that happened after was a 5-month win streak, and you can see this here from the AI investor sentiment survey. 37.1% of investors are bullish and 38.6% of investors are bearish. So if you're a bear right now, I mean, that's kind of starting to be the overcrowded camp as far as sentiment is concerned. Everyone seems to have that same opinion that markets are too expensive, that stocks need to come down. And when everyone has that opinion, it usually does not happen. Now, can it happen? Yes, but it usually doesn't. And you can see here that JP Morgan joins the SPX 6300 camp by month end. And honestly, at this point, I mean, that looks to be probably the most likely scenario. That would be an over 4% rally for December. But I don't really see at this point a catalyst to really knock the markets off the momentum that we're on right now. I mean, Trump has already threatened a 100% tariff on China and on India. Markets kind of shrugged that off because he can't do anything at the very, earliest until January 20th or January 21st. I mean, you have a coup going on in South Korea with martial law. You have all these things going on, and nothing is derailing our markets. I would not be betting against stocks here. Now, I do think there will be a correction in Q1 2025, but until then, I think markets' path of least resistance is most certainly higher. And I wouldn't want to fight that or fade that as of right now. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.